Kering is a company known primarily for its fashion brand Gucci, which accounts for approximately 70% of the total revenue. In 2023, a CEO was appointed. It hasn't performed very well, as since that moment, around July 2023, the stock price has further declined by 55%. But if you zoom out, it was actually a kind of wall ship. Since 2021, when the valuation was very high, the stock has dropped by nearly 70%. A new CEO has been appointed. This could potentially give the transition new momentum. But Kering still needs some time to grow. Nevertheless, this can be a very interesting company. It has a small competitive advantage with a number of strong fashion brands, including something with Bodega and Gucci. And we will see. It may be an interesting stock tip for long-term investors. I personally do not own shares in Kering and am not very familiar with it. I would rather go for Louis Vuitton as a company/investment. But the valuation has fallen so much that it could be an interesting undervalued stock, and with a high dividend. So this could also be interesting for dividend investors. First of all, the Morningstar fair value estimate is €450 according to their analysis. I must say, from experience with Morningstar, it can take a very long time before the fair value estimate is reached, and sometimes, when a stock continues to decline, they suddenly keep adjusting their fair value estimate downward. But that is of course very difficult, and you must always be able to calculate the intrinsic value yourself. The current price is $235, so the margin of safety rule of 50% that Warren Buffett advocates based on his mentor Benjamin Graham would apply here. So invest in high-quality companies with a strong brand and always with a 50% margin of safety. This could be applicable here. Kering even receives a 5-star rating from Morningstar. They provide some advantages and disadvantages, as all analysts do. Ultimately, you have to make your own choices, and in this video, I present just a few sources of inspiration with high-quality data sources and analyses to help shape your decision. I do not own shares in Kering myself, nor am I interested in them. But that does not mean this video cannot be valuable for you if you are interested. For example, the historical valuation as we see here. As mentioned, in 2021 the price was indeed very high with a price-to-earnings ratio of around 35. Not extremely high, but it turned out to be much too high, and we now see that the stock price is declining significantly. Actually, the stock price is now starting to trade around the fair value line and below the standard multiple line. This could be quite interesting. Look, we have a short-term earnings analysis up to 2026. Expected analysts, a total of 25 and 20 analysts, predict that the EPS will grow by about 13 and 17% per year. The current PE ratio has dropped to around 14 or 13. Another source indicates 13. It could be that 2024 will not be a good year for the company, which may lead to further declines in the stock price in the short term. However, if we can regain some momentum afterward, we can focus purely on the PE. From 15, the stock could achieve a return of about 10% per year, and that is including the high dividend. At the moment, the dividend is quite high. If we look at the normal multiple, let's say it is around 20, or we take the price-to-earnings ratio of 18, then Kering could even reduce its annual average return from above 15%. So it really has interesting characteristics, but the question is, what will the new CEO do? Can they regain the momentum? It is not only Kering that is affected by a cyclical movement in fashion brands and declining revenue growth. Louis Vuitton and other types of fashion brands are also affected by this cyclical movement, and the question is, of course, how long it will continue. If it lasts longer than expected, the market will react to that in the short term, and the stock price will become even cheaper. The current price-to-earnings ratio of Kering is around 14, and the projected ratio for next year is around 19. The 19 is now super interesting and is in line with the sector median. The EV/EBITDA is below 10, which is favorable. And we see here the price to cash flow, which is around 7, and that is also favorable. We see a dividend yield of 6%, but there is a significant but regarding Kering. And that is the total debt. They have a total debt of 20 billion, of which long-term debt is around 11 billion. The cash position may still be sufficient in the short term, but the higher the debt, the higher the interest costs. Let's look at the dividend and then the finances. First, the dividend. The company has been paying out dividends for 12 consecutive years. There is indeed some degree of dividend consistency. However, there is hardly any dividend growth. In the dividend scorecard, there are several factors needing improvement. So, it is not the best dividend stock available. Regardless of the situation, the dividend yield is currently 6%, which is high. There is significant debt involved, 20 billion in debt. We have an EBITDA of 5 billion here. Divided by 20 is 4. EBITDA ratio, 4. Above 3. Ideally, below 3 is better. The company's long-term debt is high. There's a downward risk. This is crucial for understanding the financial health. What is your criterion for risk? My criterion for risk is permanent loss of money. I do not want permanent loss of money. Companies with large, significant debts relative to EBITDA can really face serious problems, even going bankrupt, so be careful with this. And I also took a look at the trend. You can see from 2018, 2019, and 2020 when debt was very cheap. The debts were still relatively low compared to the current debt level. So apparently, purely based on this trend, the company needs money and has attracted funds to solve short-term problems. But the question is, will this succeed? Yes or no? So, purely for this reason, I wouldn't really get very excited about Kering. Even when I look at the revenue figures for both the short term and slightly longer term, I don't find this company very appealing. For me, this is already a skip. Certainly in relation to all the opportunities, all the chances that are available, and all the great stocks, we publish weekly analyses of value, growth, and dividend stocks on our website. We have all sorts of much better opportunities with much less risk than Kering. At least, that seems to be the case. However, as I mentioned earlier, based on the forecasting projections, purely on the basis of facts and data regarding EPS growth, it could be an interesting entry point, as long as you take the high debt into account. The profitability of Kering is indeed good, and this also shows that it has a healthy market position, at least in relation to the sector median, but also compared to industry peers. Also, a healthy net income margin that was actually much higher before at 16%. 16% is actually quite good. And the whole day, it is 11%. So here, this is favorable. Why? Because if the company can resume its momentum, then the profit margin can also rise again. For example, to that 15% or maybe even more. Yes, and suddenly a PI of 13 doesn't seem like much anymore, so this is very important. I just think that in the short term, it is a bit too early to determine whether I should invest now. Zegshenk indicates a strong sell, but does not provide the in-depth analyses that we often do. It also has to do with the fact that this is a company from France, and Zegshenk is more focused on USA equities. This means that you could gain a network potential of minus 25%. It's never really certain, and there isn't really a significant support line to be found here. Yes, maybe at the price level of 185, but that still implies a downward potential of minus 25%. This means that Kering's stock would have to drop significantly compared to the last peak. However, you should not take that last peak into account. It was clearly overvalued. However, let's look at 2022, minus 45%. It could very well decline further. A brief conclusion based on a number of facts and data. A very cautious conclusion is that, at the very least, the valuation seems to have become more interesting for long-term investors. Everything depends on whether Kering can grow further in the short term and also in the long term. And if you are an optimist and believe in brands like Gucci, which accounts for 70% of their revenue, then the entry point is starting to look more attractive. Perhaps the best methodology here is dollar cost averaging. Who knows? Much more importantly, you need to conduct much more research on this company, look into the annual reports, and formulate your own scenarios while strongly considering the high debt. Look at what the downside potential is, and perhaps in the short term, the stock may decline, which could present an even better opportunity at that moment.